Afternoon. It's very pleasing for me to see the good number of people that have come along to this, probably about twice as many people as came along last year. Last year, some of those here will recall that I gave a speech about shining a light on unfairness in the tax system. And I noted that many people look at our headline personal income tax rates and see a system that charges higher tax rates on higher taxable income, and they assume that that means that the system that we have in New Zealand is progressive overall. It isn't. I said that it's rare for the debate to properly factor into the effective rate of the regressive tax that is GST as a percentage of income, or for that debate to include economic income that is untaxed. I noted that there's a sense of unease, and I still believe this to be true, especially among younger New Zealanders who see their opportunities constrained by inequities in the current tax system. Many believe that those that are better off than themselves can structure their affairs to pay lower tax rates, but they've never been able to prove the scale of it. I said that the Labour government believes it's the responsibility of government to shine a light on this, and noted that only IRD can gather the data needed. I spoke of two key projects underway at Inland Revenue, the High Wealth Individuals Research Project and the tax principles work that we're undertaking. I'm here today to announce the results of the IRD research, and for the first time we have hard data confirming fundamental unfairness in our tax system. The study looked at the income and tax of people who generally had a net worth of more than $50 million or $20 million if they controlled significant businesses, and it looked at their income and taxes over the 5-year period from the 1st of April 2015 to the 31st of March 2021. Inland Revenue requested information on 350 high wealth individuals and their immediate families. That's described in the report. It's essentially 311 individuals, 238 of their partners, and 27 dependent children. Of those 350, 311 responded. The median wealth or net assets of the group in 2021, the start of the period, was $106 million, and the average, the mean, was higher still at $276 million average. In total, these 311 people have a collective wealth of $85 billion. The data shows beyond doubt that the wealthiest New Zealanders pay tax on their economic income at a rate well below what most New Zealanders pay on theirs. It shows that the effective tax rate paid by middle income New Zealanders is at least double that paid by our wealthiest citizens. This finding is truly groundbreaking. The work we have done to substantiate it puts us at the forefront of those countries who are trying to better understand the fairness of their tax systems. This study is an analysis of actual data. It's not a theoretical model or an analysis of scenarios. I want to be clear that today I'm not announcing any new tax policy or tax switch. Labour's tax policy will be announced before the election. I do repeat again, though, that I've never favoured taxing the family home, either by way of capital gains or imputed rents. High rates of home ownership are for me a cornerstone of a fair society. Before I get into the substance of this work, I'm going to talk a bit about the background and how IRD conducted its study. The first point to note is this is a debate about the distribution of tax, not total tax. New Zealand's not a highly taxed country. We sit in the middle of the OECD pack for total taxes, and you can see on the white bar there that's the OECD average, and New Zealand's taxes are shown in the red bar, slightly lower than the OECD average. Those taxes don't change hugely as a percentage of GDP from year to year. New Zealanders want to know that their tax system is fair, and indeed voluntary compliance with tax obligations, which the system relies upon, itself rests upon the system being seen to be fair. Salary and wage earners do pay a fair rate of tax. When they earn an extra dollar, they expect to pay tax on it, and they expect other people who earn more to do the same. But how can an individual understand what their fair share is if they don't know how much tax people with higher incomes pay? We can only get this right if we know what the facts are, and this requires real data, not scenarios or models. We know that most New Zealanders earn the bulk of their income in salary and wages, which are taxed. Currently, as I've said, some people look at those headline personal income tax rates and they see a rate that changes on higher incomes, and that's shown on this slide here. The green bar is the marginal tax rate that people pay on their next dollar of income as their income rises. The blue bar is the average during that journey, if you like. So if you're someone that was on here at about $100,000, your average tax rate across your whole $100,000 would be around 25% there, as you can see. So people see that and they assume that this means that the system is progressive overall, but it's not, because what is not apparent in this graph is the types of income that are earned predominantly by the very wealthy, and this is an important and, the graph also excludes GST. So what the graph in fact fails to show is that the average tax rate for middle income Kiwis is generally much higher than it is for their wealthier co-citizens. We've known for some time that some of the wealthiest New Zealanders don't pay tax on some of their income, but we've not known how much nor what their overall effective tax rate is. Not all taxes need to be progressive. I'm a defender of GST, but the overall system ought to be. This is a settled principle of tax theory. A major obstacle to understanding the current unfairness has been the lack of reliable information. Until now, we've had to rely on the Household Economics Survey for information on the wealthiest New Zealanders. While that survey provides comprehensive information for most of the population, it's not accurate at the top end. Last year, I noted that the Household Economics Survey had surveyed just one household with wealth greater than $20 million. They've now found two. That's right. The NBR Rich List is a better data set than the official statistics when it comes to high wealth. We've been similarly in the dark about economic income. Why is it in a country with billionaires we have a data set used for policy purposes which effectively ignored the wealthiest? It's not out by a factor of 10, that would be huge in itself, but the maximum is out by a factor of hundreds. Despite the limitations of household surveys, they have told us that wealth is unevenly distributed in New Zealand. According to that Household Economics Survey, the top decile, which is the top 10% of households, holds 63% of household net worth, excluding owner-occupied housing. This is more than the other 9 deciles combined. There's a massive difference between decile 10 and decile 9. Further down the tree, it's even more apparent. In fact, 50% of the population hold only 7% of the net worth outside the family home. In contrast, the top 1% of households hold more than a quarter of all of the financial assets in New Zealand. This means that most income from investments is earned by a small segment of the community. The data being released today shows that wealth is actually more concentrated than the Household Economics Survey tells us. And this is something that leading economists like Thomas Piketty and Sayers and Zuckman have been telling us. Surveys understate the concentration of wealth, while data makes it clear. Today's report also shows the tax paid. Until now, we haven't known the total income of that segment of the community, nor how much tax they pay on that income. We, of course, know the rate of tax paid by wage and salary earners, by small business owners, but not the rate paid by the top cohort. This has made comparisons guesswork until now. That's wrong, and it's why the government moved to enable IRD to address this data gap. Parliament confirmed this much needed information gathering on the Commission of Inland Revenue. Before then, wealthy people and their intermediaries, the accountants and the lawyers, could refuse to provide this information. IRD was allocated funds to collect research relating to the tax paid by wealthiest New Zealanders relative to their economic income. That is their income from all sources. The project was not targeted at tax administration for specific individuals. It's entirely separate from Inland Revenue's compliance activities. And it's not a criticism of those surveyed. It's not about chasing tax avoiders. Wealthy New Zealanders are usually hard-working and creative people who comply with current rules. And their cooperation has enabled this study to provide critical information about the rate of tax they pay compared with others, and I'm grateful for that. IRD's methodology has been critiqued and improved by outside experts. It is the IRD's report, not mine. It is their careful analysis, and you can trust and rely upon it. So today, Inland Revenue is publishing its findings on the effective tax rates for high wealth individuals. IRD has analysed their various sources of income and the tax they pay. Most people earn the vast majority of their income from salary and wages, which is all taxable. Their tax is paid largely via income tax and GST. For the wealthiest Kiwis, just 7% of their income is taxed as personal income. So if you look at this graph up here, the mid-blue 7% bar at the bottom is the equivalent of the salary and wages and that are the predominant source of income for most people. But for the wealthiest people, that portion of their income is only 7% of their total income. So in other words, it shows that most of the high wealth group's economic income comes from investment returns. And when I say most, I mean 93%. Now, economic income is much broader than personal taxable income. It includes all income sources that increase a person's ability to buy goods and services and pay for living costs and saving. The financial affairs of the very wealthy are often complex. They can involve, and they normally do, partnerships, many companies, sometimes hundreds of companies, and multiple trusts. So to understand the system, IRD needed to consider the income and taxes through all of those entities: personal income tax, company tax, tax paid by trusts, as well as GST. Only then can we understand how the system works overall. And the detailed analysis by Inland Revenue has done that. It's been a huge piece of work. When all sources of income and tax are included for the family, the median of the effective tax rate for the high wealth group, excluding GST, is 8.9%. 8.9% is the median rate of tax paid by the wealthiest in this country, excluding GST. This includes the tax they pay personally and the tax they pay through company tax and through trustee tax. It's all in there. If GST is added, the effective tax rate rises to just 9.5%. And I'll cover shortly why the GST-related increase in those figures is so small. In contrast, a person earning their income through an $80,000 salary with no other income pays an average of 22% income tax, and if you add on the GST they pay out of their income, their effective tax rate is 30%. So our citizens, like our tradies, our nurses, our school teachers, our hospo workers, our hairdressers, our cleaners, our engineers, our small business owners, all pay a much higher effective tax rate than their wealthier fellow Kiwis. Highly paid CEOs and professionals who earn large salaries, which of course are already all in the taxable band, they pay an even higher rate. The much lower rate paid by the very wealthy is driven by two main factors: capital income, which is mainly capital gains, and GST. High wealth individuals more often earn their income from returns on investment, largely non-taxable returns received through trusts and companies rather than directly. The report shows that 67% of the high wealth population's economic income was derived through trust structures, either as trustee income or in capital gains. As I said, just 1% of households hold more than a quarter of all of the financial assets in New Zealand. So if income earned from capital is taxed at a lower rate than the tax people pay on their income from salary and wages, then that tax advantage is concentrated at the top end. And this study proves that that is what is happening in New Zealand. Let's look at GST. Now, GST makes up 32% of total tax in New Zealand. So who pays what is very important. More important in New Zealand than virtually any other country in the world, because the OECD average for GST as a percentage of total tax is much lower at 20%. So if you've got a regressive GST system, then the effects of that are more pronounced on the other people, the majority, in New Zealand than virtually anywhere else in the world. So the OECD has looked at GST as a percentage of income. We pay it when we spend it, when we spend money. When we buy goods and services, we're paying 15% tax to the government. What's that as a percentage of income has been looked at in the OECD, and it's a fairly consistent story across countries. Consumption taxes like GST are a higher proportion of the incomes of less wealthy people, so that's not a surprise. New Zealand's a bit more regressive, you can see on the blue bars there, than the OECD average, and that regressiveness overall in the tax system is also bigger because of the high proportion of GST in the system, but the trend generally is no surprise. Most people are spending, on average, just under 2/3 of their salaries on GST inclusive goods and services. So in other words, the effective tax rate of their GST as a proportion of their income, not including capital gains, is 8 or 9%. However, GST paid as a proportion of income drops sharply at the top end. I think you'd be a bit surprised by this figure. The average person in the sample population spent 0.5% of their overall income on GST inclusive goods and services. That's a substantial and poorly understood difference. So the wealthy New Zealanders not only pay much lower proportions of their income on income taxes, they also pay a lower proportion of their income on GST. I'm going to come back to the total rate including GST, but first of all I want to also cover the Treasury report that's out today as well. So the Treasury have produced an accompanying report to the IRD report that looks at the entire population. Now, unlike the IRD report, which is based on individual data, the Treasury report is modelled on data based on representative surveys and economy-wide analysis of income and tax. It's still important because it enables us to make comparisons between the finding of the High Wealth Individuals report and other New Zealanders, because we know that those surveys are pretty accurate for the rest of New Zealand. It outlines the effective average tax rates on a based on comprehensive measures of income across the population. It's another quality piece of work, and I think the Treasury officials have done it. The report includes multiple scenarios. It includes things like transfer payments, benefits. It looks at people with dependent children, because lots of people are in different circumstances, and it looks at people with different sorts of investments, and it looks at housing differences. Some of these are complex. Some of them, for me, I find a little academic. For example, I'm not a great fan of some of the scenarios that include imputed rents and capital gains on owner-occupied housing. I don't put much weight on those scenarios for several reasons. For me, the deemed income or capital gain can't normally be spent. You need to live in a house. And I'm also happy to exclude the higher imputed rents and capital gains on the more expensive houses naturally owned by those who are more wealthy. So for me, I prefer estimates that exclude imputed rents and capital gains on owner-occupied houses across all income and wealth levels. But I've nonetheless or not me, the department's nonetheless included this data. I say that to avoid misrepresentation of my views on this, but also to show that even when those scenarios are used, middle income owners are still paying much higher rates of tax than the wealthy. The Treasury scenario shows that the tax rates paid by New Zealanders, including GST, are between 6.8 and 10.8 percentage points higher than the estimates for the high wealth population. Or put it another way, even when a broad definition of economic income is used for middle income New Zealanders, they're still paying twice the rate of tax on their income, again including GST. This report and the Treasury work considers GST for the high wealth population and the rest of the community relative to their economic income, that is all of their income including capital gains. It shows that the amount of GST paid by the average high wealth family is around 0.5% of their overall income. Now that's really regressive at the top end. It just shows you how surveys that don't capture the top end don't actually capture the full picture. The Treasury study finds that taking into account all income sources, the effective middle income earner has an effective tax rate, including GST, of around 20%. So the Treasury's alternative analysis, which sits as a companion to the IRD work, again shows middle New Zealanders paying more than double the rate of tax of the wealthy. There are other interesting findings in these reports. For example, on average, the higher the ownership interest a wealthy person has in a private company, the lower its tax and dividend rate. This is further evidence of the incentive to reduce taxable income and instead focus on capital growth and tax-free share sales or capital distributions. There are a lot of reasons behind that, including higher rates of leverage. New Zealand is not the only country doing work in this area. The increasing concentration of wealth and the lower rates of tax paid by the very wealthy is of concern in many countries. For instance, the OECD Centre for Tax Policy has a current project that's looking at stylised effective tax rates under different compositions of labour and capital income. This work's due to be published soon. These models that are being used in other countries show that people earning income from labour have higher effective tax rates than those with a mix of income from labour and capital. Inland Revenue have followed a similar methodology to that which is being used by OECD currently. But unlike their work, which is based on scenarios, New Zealand's is on actual data. Some of the OECD countries do have less extreme differences than in New Zealand, and that'll be coming out in the next months. You have to look to a country like the USA to find extremes similar to us. In 2021, the United States Council of Economic Advisors undertook a study on the effective tax rates of their 400 wealthiest families. It estimated that the average federal effective tax rate for income tax for the period 2010 to 2018 for those families was 8.2%. This is remarkably similar to the result found in this inland revenue. However, some American states also have other taxes, so it may be that the New Zealand outcome is more extreme than in even some states of the USA. I believe this survey will be of great interest to the OECD and other jurisdictions, partly because it's grounded in actual facts, not models or scenarios. So, now what next? We know that wealthier New Zealanders pay on average under half the rate of tax paid by middle income earners. But what, if anything, do we do about that in New Zealand? Well, we're not providing the answers today. That's for the future. The findings of this report will contribute to an informed debate on the fairness of our tax system. It will allow future tax policy to be based on better data and solid evidence. Can I thank those of you here today who have helped guide and support officials in conducting the research, and those of you who worked with your clients to help achieving the high response rate to the survey. It's been in all of our interest to make sure that this work can be as good as it can be. This report brings a greater transparency to our tax system. It hasn't been about attacking the very wealthy, but it is asking a proper question: who is or is not paying their fair share? So what happens next? Well, I believe most New Zealanders will always want to know if the tax system is fair. They know their own tax affairs are simple and that they and the IRD understands their income well. The Labour government believes Inland Revenue needs to continue to monitor and report on how the tax system is in fact operating across all strata in society. The government is planning to introduce a series of tax principles. These tax principles will require tax policy officials to regularly report on key fundamentals of the tax system. Lots of people have strong views on what tax policy should seek to uphold. But surely we can find a high-level common ground upon which information can be reported and upon which a proper debate can be based. Successive tax inquiries in New Zealand and overseas have described the main principles of a good tax system. They're uncontroversial. All want a modern tax system to operate efficiently and effectively by keeping administrative and compliance costs low. In New Zealand, we try to deliver workable tax policy through our generic tax policy process and public consultation. Most people agree that a good tax system incentivises work and avoids distortions through uneven tax treatment of business and investments. But above all, a tax system seeks to uphold that most core of New Zealand values: fairness. Fairness in tax has two main aspects: horizontal equity, that should ensure that people in similar positions contribute similar amounts, and the vertical aspect that should achieve progressivity, or at least avoid regressivity in the system. The High Wealth Individuals Report finds our system is regressive at the top end, meaning that very wealthy New Zealanders pay much lower rates of tax than middle-income Kiwis. This new reporting framework to be created will seek to provide information on the tax system related to these principles. This will help to provide an informed debate. Our proposal is to require officials to report periodically on the operation of the tax system, using the principles in the legislation as the basis for their reporting. This will build up a time series showing how the tax system is changing in relation to these core principles. By providing information to the public like that presented in the High Wealth Individuals Report today, we can have an informed debate on tax using solid evidence. The debate around this High Wealth Report and the tax principles adding requirements for ongoing public information will result in a stronger economy. The economy will be better if the tax system is fair. It will also be a fairer tax system and make for a better New Zealand. I appreciate you taking the time to be here. Could I particularly shout out to the officials that have led this work? They've done a fantastic job and I will be eternally grateful to them. I'm happy to answer a few questions. Yep.
So this research has confirmed what you suspected, that the tax system is unfair. Do you have the courage to fix it?
Yes. But we have made it clear that we're not making significant tax changes today. Of course, during a term of government, those decisions are for Cabinet. And at election time they're for political parties, and the electorate will know the answer to that question. What's our future tax policy by the time we get to the election?
And over the course of the study from 2017, the wealth of these families went from $1 million to $14.6 billion. That was under your watch. Are you comfortable with that growth in their wealth?
Well, in some ways it says that the economy's been growing very strongly under a Labour government.
Are you comfortable with that? Are you comfortable with that?
I'm on record as saying that we need a fair tax system. Yeah.
Sorry. paving the way for wealth tax. But I'm just wondering, what's the direct, because for people, it's not going to affect me, but I'm just wondering, what's the direct kind of connection between when you tax more to the rich people, what are you going to do to reduce the inflation and the cost of living, which is a real problem right now for just about most people, middle class and low income people. And another thing is that some countries decide to do that, to do it this way, tax rich people more. And in China, and both in China and US, a whole lot of rich people move their business, move their wealth overseas. Are we worried about these trends? Because it's going to affect the economy if they...
Okay, I think I've got the essence of your two questions. As I said, I'm not announcing any tax policy today. In respect of your second question about what is the effect on different sectors of the population, of course, if you do have a tax switch, then the money doesn't disappear. It just goes from one section of society to another. Yeah.
This time a year ago when you announced the survey, you commented about the tax working group that was set up by Labor, which was more or less unanimous in recommending the capital gains tax, but you said you couldn't get the numbers through Parliament. And I just wonder if this is going to be 2.0 of the same sort of scenario.
Look, I'm on record as having for different periods in my political career advocated for a capital gains tax, and I don't resile from that. It's not necessarily the best or only solution. I again make the point that I'm not announcing any tax policy here today, nor preempting what the Labor Party may do or not do in the election. I think implicit in your question is why, if this is so obvious, why can't something be done about it? One of the problems has been is that we have not had unarguable data. We now do.
Yeah, how did the Inland Revenue determine the 350 individuals or families to do it? And you talked about 311 out of 350. What's happened to the other 39? Are they going to get told off or what?
In respect of the first question, it's described in the report in some detail, but essentially Inland Revenue relied upon their own knowledge of where they thought who they thought the high wealth individuals were, and also had data available, no doubt, things like the NBR rich list. It won't have covered all of the wealthy people in society because we don't know who they are. Although we're pretty sure it's a decent sample. In respect of the issue as to what's going to happen with the 10% who didn't comply with the survey, that's an issue for Inland Revenue, and I don't interfere with that. Yeah.
Thanks. It was a really revealing report, and I totally support the work that's been done using real data to get information. But I'm just concerned about what's your message to people who are on the decile 10 income and who will now find out that it's not a fair tax system. And I know you're not announcing policy, but I think it's a really significant message that you've just delivered.
Well, I suspect the opinions within that group will differ as between different people. Some of the wealthiest people in the world think we need fairer tax systems around the world. Most people, of course, only pay what they have to pay. That includes most of the people in this room. We don't make extra donations to Inland Revenue Department if we don't have to. I can't answer for them. I do know that the concentration of wealth, the average, what did I say, the average family here was $265 million, was it? Was it $276 million? I think that average will surprise people. It surprised me. I've got some well-off friends. I phoned them and asked, just this morning, I said, what do you reckon the average was? Very few of them got it. Indeed, one of the interesting things in this report, which is covered in the report, is it does prove that the distribution of wealth, even though it's quite skewed according to the household economic survey that I mentioned, this study proves that it's a lot more skewed than that. Jeff.
Without the benefit of reading the report, though, looking at your figure ES1, which is the one you put up about the sources of income, do you have in here a breakdown of those capital income categories across the three subcategories: realised capital gains, unrealised capital gains, and just return on assets held?
Yes, and by asset class. Do you want to say?
Yeah, in the report we have a breakdown of the income in 12.1.
What's the page?
So if you look at page 90, we have a breakdown for various income categories. We also calculated the breakdown between accrued and realised capital gains that we could. So we do that in chapter 13 for listed companies, and we also do it in chapter 9, chapter 9.3.
There's also a sensitivity analysis that's been done. We have come through a period of low interest rates and dropping cap rates, and so some people will no doubt say that capital gains during this period may have been higher than may have been the norm during other economic cycles. One, Inland Review have had a look at other economic cycles, and those other economic cycles aren't all that different. Secondly, they also, as the report shows, have done a sensitivity analysis, and even if there is a substantially lower assumption as to the increase in capital values, i.e. capital gains are lower, the actual effective tax rate doesn't change all that much.
With respect to page 90, I'm looking for realised and unrealised capital gains.
Yeah, so in chapter 13 on 105, page 105, we talk about the listed companies. So for listed companies, so we did listed companies over 17 years as well. So there was $6 billion in accrued capital gains for the population of the state over that period, and 1.7 in realised. We also do it for in table 9.3 for property, but just because of the data, we could only do realised capital gains for those two particular instances. So table 9.3 is the other one, table 9. Yeah, but you come to the afterwards.
Yeah.
Minister, these numbers show that if the 311 families had paid the same tax rate, effective tax rate, as middle income New Zealanders, 30%, they would have paid an extra $2 billion, just that 311 families, in 2020 and 2021, if they paid the same rate as everyone else. What would you say to those people in that group, who don't know the names of, who no doubt are campaigning against any sort of attempt to tax that $14 billion of income they made that year? What would you say to them?
I would say that we live in a society where we rely upon an educated population, sealed roads, a police force that we should all fairly contribute to, and that that is for the benefit of everyone. I saw a speech from President Biden online about a year ago, where he said that, under a fair tax system, the middle class is strong and the wealthy do just fine. They'll still be the wealthiest people in society by far, and still be earning a lot more after tax, no matter what we do. This gentleman here.
Thank you, Minister. A lot of the results seem to be hinging on these unrealized capital gains. If we're counting those as income, just as a matter of high-level tax policy principles, how should we be thinking about unrealized gains? So you put up the fraction of effective income that people are paying in GST. It seems to suggest people aren't drawing that much out of their unrealized gains through borrowing. Otherwise, you would have seen they're paying a lot more in GST based on those unrealized earnings, right? So, as a matter of high-level principle, should tax policy be trying to tax unrealized gains, not tax them? How should we be thinking about it when those, at least in the company data, were 70% of the overall gains?
Well, again, I'm not going to say what the appropriate response is, but once you get to the top end, you actually never need to sell anything. You can just buy ever more.
When you look at the evidence of a report like this and the tax working group report, which clearly show that most New Zealanders would be better off with some sort of wealth or land or capital gains tax, why do you think they are so reluctant to accept the idea of a fairer tax system?
If I could have done a better job of that during my lifetime as a politician, I would have. I can't answer that. New Zealand is an outlier. We think we're part of the average, but we're not.
Is it a communications issue?
Well, politicians and people like yourself have been trying to communicate these issues. We haven't succeeded.
I'm on the lower end in that range. I get super, and which basically just pays for my rent, and I'm still working. And IRD just moved my tax rate to a point I still pay student loan. So I paid, IRD moved my tax rate to SHSL, which is a 30% tax rate from the first dollar I own in my work. So I pay this 30% and 12% student loan, it's 42%, and they have also 8% on Kiwi Saver, so because I don't have much savings, to build up my savings. So I did just with this figure, then ACC comes on top and says 50% every dollar I earn goes out before I even see it.
Well,
the question is, how come that IRD charge?
Well, you're probably ahead because of your superannuation, but I would it actually shows how different individual circumstances are different, and it's one of the reasons why the Treasury study I think is quite helpful, because although your particular instance might not be one of the scenarios that they've run, they have run many different scenarios, and all of those scenarios really show that the middle pays a higher rate of tax than the top.
You mentioned that you're a big supporter of GST for fairness and equity. Bearing in mind what you've now found out in this and who's paying the bulk of that GST or having portions of their income impacted by that level of GST, do you think we've got the matrix right as far as the rate of GST as compared to tax rates?
I don't think the answer, if there is to be an answer to this issue, lies in GST. Yeah.
Thanks very much for the statement. As a former member of the tax working group, it's really great to see at least one of our recommendations carried out, so thank you for that. If I could just continue on the recommendations about making information about our tax system more readily available. Another part of it was to compare with Australia, which has much better statistics on who pays taxes, including in particular the by industry, by companies, by industry. So my question is whether you will carry on this laudable process of regular reporting on parts of the tax system to other areas such as those recommended by the tax group.
I'll go back and have a look at those other recommendations. I haven't read them for a while. But in terms of the tax information component, yes, I certainly believe that we should have better ongoing data series. I think transparency is absolutely fundamentally important. Not that are unsolved, because we have in recent years improved the transparency around the reporting of trust assets and income, so that we now have good information on those trusts. But we haven't always had that information. I'm not sure when did we start collecting. David, you might recall, when did we start getting better information on trusts? 21-22 tax year.
Yeah. Do you think that will help improve the capital rate, implications for the high income groups?
I don't think. Well, look, I'm not suggesting these people aren't complying with current tax rules. And that's not the suggestion.
It was mentioned earlier that there was about $2 billion in tax stack was the difference between the wealthiest citizens were paying and what median citizens were paying. What could the government have done with $2 billion during 2020?
I'll take that as a rhetorical question. but you've heard me talk tax switch language. There's many ways you could switch things. But again, as I say, I'm not here to announce tax policy, and yeah.
How comparable is the Treasury and the IRD reports? Like Treasury used a growth rate on land at like 4.5%. An IRD used between 9 and 13%. Hence, you've got different gains. So how comparable are the two reports?
Well, they are slightly different methodologies. They've worked largely independently, although some of the wealth distribution information that is included in the Treasury report is informed by the way that you can update a model as to the distribution of wealth according to the information that we found in the IRD high wealth individuals point. Although the methodologies are slightly different, the answers are still remarkably similar, and that they both find that middle income New Zealanders are paying twice the rate of tax of the very wealthy. Yeah. I think that's very true. And the question was, if I could restate it, that should we take into account transfer payments like accommodation supplement, benefits, etc. Yes, we should, and these reports do. And I would say, as a general proposition, we do have quite a progressive system at the bottom to the middle. And it's pretty fair. There will other people who have disagree with that, but those transfer payments sort of stop about the middle, and the unfairness that we have is right at the top end. But it is significant, as other questions have shown. Well, I think, shall I take two more, and then we call it quits? Yeah.
Could I just make an observation that, in my perception, what at least some of wealthy individuals, very wealthy, think is fair, and what the accountants and lawyers and advisors perceive as fair, maybe two different things.
That's absolutely true. I know that to be true, because some of the accountants and lawyers who represent those individuals and comply with tax laws and do their job for them do not think the system is fair.
Minister, you're introducing a Tax Principles Act, and most of the tax system we have is based on a broad-based low rate, at least for GST and PAYE. How would you apply a broad-based low rate principle to tax?
Well, I don't think we do have a broad-based low rate system in New Zealand. I think it's a myth.
You mean overall?
Overall, yeah. We have a broad-based GST system that is at a lower rate than if it collected the same amount of money over a narrower range of goods. But we haven't got a broad-based low rate system compared with a lot of countries in the world. Okay, I'm going to call it quits. Thanks everyone.